Many people want to invest their money in the financial markets, but they may not have the time, knowledge, or resources to do it on their own. That's where mutual funds come in. I'll explain what mutual funds are, how they work, and what are their pros and cons. I'll also give you a case example of how to choose a mutual fund that suits your goals and risk tolerance. So, what are mutual funds? A mutual fund is a type of investment that pools money from many investors and uses it to buy a wide range of securities, such as stocks, bonds, and other assets, under the guidance of a professional portfolio manager. A mutual fund is managed by a professional portfolio manager who buys and sells securities according to the fund's investment objectives and strategies. When you invest in a mutual fund, you own shares of the fund and its income, and you can sell them anytime for their market value, minus fees or charges. There are many other types of mutual funds, such as sector funds, international funds, money market funds, and specialty funds that cater to different investor preferences and needs. Some of the common categories of mutual funds are: 1. Equity funds. These are funds that invest in stocks of various companies, with different goals and methods based on market size or location. Equity funds tend to have higher returns and higher risks than other types of funds, as they are subject to the fluctuations of the stock market. 2. Fixed income funds. These are funds that invest in bonds or other securities that generate regular interest income from various issuers, such as governments or corporations, with different levels of risk and duration. These funds tend to have lower returns and lower risks than equity funds, as they are less affected by the stock market and more by interest rate changes. 3. Balance funds. These are funds that invest in both stocks and bonds, with different proportions depending on the fund's risk level, to offer a combination of growth and income. Balance funds tend to have moderate returns and moderate risks, as they benefit from the diversification of both asset classes. 4. Index funds. These funds invest in securities that follow a specific market index, such as the S&P 500 or the NASDAQ 100, and replicate the performance of a stock market segment. Index funds tend to have low fees and low risks, as they follow a passive investment strategy and have low turnover. Now that you know what mutual funds are and how they are classified, let's talk about their pros and cons. Investing in mutual funds has many advantages, such as: 1. Advanced portfolio management. When you invest in a mutual fund, a professional portfolio manager selects and manages the securities for you, and you can benefit from their research, trading, and strategies. 2. Diversification. When you invest in a mutual fund, you spread your risk over many securities in one fund, so a single failure has a minimal impact on your investment. Diversification also lets you join the growth of different sectors, industries, and markets, which may boost your returns over time. 3. Convenience. When you invest in a mutual fund, the fund company handles and tracks your investment, saving you from the hassle of multiple accounts, transactions, and tax forms. You can access and automate your liquid and tradable mutual funds to grow your wealth faster and easier. 4. Fair pricing. When you invest in a mutual fund, you buy or sell your shares at the net asset value per share, the fund's true value at the end of each day, which is the market value of the fund's assets divided by the number of shares outstanding. For example, suppose you invest in a mutual fund that has 100,000 shares outstanding and a market value of $1 million. The net asset value per share of the fund is $1 million divided by 100,000 equals $10. If you buy 100 shares of the fund, you pay $10 times 100 equals $1,000. If you sell 100 shares of the fund, you receive $10 times 100 equals $1,000. The net asset value per share reflects the fund's true value at the end of each day, regardless of the demand or supply of the shares in the market. However, investing in mutual funds also has some disadvantages, such as: 1. High fees. When you invest in a mutual fund, you pay fees for the fund's services, which vary by fund and lower your returns, especially for short-term or frequent investments. These fees can range from 0.5% to 3% or more per year, and up to 5% or more of your investment amount. 2. Tax inefficiency. When you invest in a mutual fund, you pay taxes on the income and capital gains that the fund distributes to you, or that you realize when you sell your shares, regardless of your reinvestment or the fund's performance. These taxes can lower your after-tax returns, especially for high turnover or high dividend funds. You can avoid or defer some taxes by investing in a tax-advantaged account, but you still pay taxes when you withdraw your money. 3. Per trade execution. When you invest in a mutual fund, you buy or sell your shares at the net asset value per share, which is set at the end of the trading day. You can't control the timing or the price of your transactions, unlike other securities that trade all day. You also have to wait until the next day to know the exact amount of your investment or redemption, which can be inconvenient or frustrating. You may also miss some opportunities or incur some losses due to the lag between your order and its execution. 4. Management abuses. When you invest in a mutual fund, you trust the fund manager to make investment decisions for the fund. Some fund managers may do unethical or illegal things that hurt the fund's performance and reputation. You also depend on the fund manager's judgment and skill, which may vary. You may get a fund that does worse than its benchmark or peers, or changes its objectives or strategies. As you can see, investing in mutual funds has its pros and cons, and you have to weigh them carefully before making a decision. To help you with that, let me give you a case example of how to choose a mutual fund that suits your goals and risk tolerance. You are a 25-year-old investor who wants to save for college, and you have $5,000 to invest. You want steady long-term growth with low risk and moderate liquidity, and you don't need your money for 10 years. How would you go about choosing a mutual fund for your portfolio? Here are some steps that you can follow. Step 1. Define your investment objectives and constraints. You need to know your investment goal and the factors that influence your choices, such as time, risk, liquidity, tax, and ethics. For example, you want to save for college with low risk. Step 2. Research and compare different mutual funds. You need to research and compare mutual funds that suit your goals and limits. You can use online platforms, such as Morningstar or Yahoo Finance, to check their performance, fees, ratings, strategies, and more. For example, you may want equity funds that invest in large-cap companies with stable growth and dividends. Step 3. Select the best mutual fund for your portfolio. You need to evaluate each mutual fund option based on your goals and limits. You also need to consider the diversification benefits of a mix of securities in one fund. For example, you may choose an equity fund with low fees, high ratings, diversified sectors, and consistent performance. Step 4. Buy or sell the mutual fund shares. Once you have chosen the best mutual fund, you can buy or sell its shares online broker or an app. You can also automate your contributions or withdrawals from your bank or paycheck to make investing easier and consistent. By following these steps, you can choose a mutual fund that suits your goals and risk tolerance. However, remember that investing in mutual funds involves risks and uncertainties, so always do your own research before making any investment decisions. Thank you for watching. I hope you learned something new and useful. Please leave a comment below and let me know what you think about it. I'll see you in the next video.